Hi everyone, thanks for joining our webinar today. My name is Iqbal Branch and I head up marketing and product strategy for OptionsCity. As you may know, OptionsCity's mission is to simplify the way clients think about and utilize trading technology. We've been in this space for 9 years now and have offices here in Chicago as well as New York and London. OptionsCity has taken a hybrid approach to software development, spanning the spectrum between building your own custom solutions as well as buying an off-the-shelf solution. We believe this allows clients to have a quicker time to deployment while maintaining the custom functionality that they require. OptionsCity is the leader in options on futures software across major asset classes with 2 core product offerings. We offer CityTrader, which is a web-based platform for professional traders interested in trading futures and options on futures. And we also have our flagship product, Metro NOW. Metro NOW is largely focused on market makers, proprietary trading firms, and institutional traders. The presentation today is geared toward users of our Metro NOW platform. Today we're excited to talk about Metro NOW and Eurex fixed income options. I have joining me today Loren, Reinhardt, Business Development at OptionsCity, and Rex Jones, Global Product Research and Development from Eurex. We expect this webinar to last 30 minutes and we'll leave plenty of time to answer your questions, which you can submit through the GoToWebinar. With that, I will turn it over to Rex.
As I said, I'm Rex Jones. I work in product development, and our mission is to, create new liquidity pools together with our clients. And we also have a wide range of products that are, more established in terms of their product evolution. So I'll dive into the topic with the product outline and the contract specifications that I'm sure many of our U.S.-based listeners today are well accustomed to. The products are very similar to what are traded in the States based on treasuries, and we'll highlight volume and open interest figures and provide some measurements of screen liquidity, both for calls and puts, but also with a special focus on tailored option strategy trading before looking at some of the product nuances, both in comparison to treasuries, but also with a focus on the product applications that many of our primarily institutional client base, how they use fixed income options, be it in risk mitigation to enhance returns, or for plain vanilla hedging of government bonds. If we move on to the product outline, bond trading in itself, has its roots in the cash market, and it's complemented by futures trading through the basis between cash bonds and futures, and then optionality is on top of that. For example, with our is given on top of that with our products in terms of fixed income options. So this allows for more tailored investment approach, and these are available for a range of tenors, usually monthly expirations. There's a long history of floor-based trading, both in the States and here in Europe, and this has favored the evolution of a very market, especially at Eurex and fixed income options, that has a strong focus on the professionals market. Nonetheless, we've established electronic quotation in fixed income options, and have permanent and advanced market making programs, and also newer programs that I'll show you the results of, where market makers provide quotes and option strategies as well. Last but not least, besides trading liquid order books, there's also the wide field of bank dealing desks and interdealer brokers providing specialized execution services, as quite customary in the European market with phone market trading. So I will not bore you with the contract specifications, just the key highlight and takeaway from this slide is for each options position, when exercised, I get 1 futures position. We have options on Bund futures. These are futures that are deliverable with bonds with maturities between 8 and 10 years. For the midpoint of the interest rate yield curve, we have Euro bubble futures, and today we'll be talking about the options on these Euro bubble futures. And this segment is complemented by liquid trading in shorter termed government bond papers, so Eurostats futures and the respective options thereon. In terms of the contract months, there's usually the next 3 successive calendar months are covered. If I look to a Bloomberg screen today, I have a December expiry. The November expiry actually went off the board this past Friday, and I then have January, February, and March expirations, all for 2016, that are available for trading with respective options. So moving on to the volume and liquidity development, I'd like to say something about the dent, the positive dent that we see for 2015 that was particularly pronounced with very high options volumes in fixed income options at Eurex. What's been happening over the last, let's say, 12 months in Europe is quite heavily driven by the European Central Bank's chief, Mario Draghi, making a statement in September of last year that he and the ECB will do whatever it takes to keep the euro together. And since that statement, you could almost look at the open interest line on this graph and see that, oh yes, something has been happening also in the option space in terms of investors positioning themselves. Whatever it takes meant basically copying what the Fed did many years back and launching a quantitative easing program in which the European Central Bank is broadly buying government bonds and a wide range of fixed income instruments out there, increasing its own balance sheet. And there was one primary type of trade that investors were pursuing since September of last year, and that was long as you can get. And what we've seen this year when the quantitative easing program actually commenced in March 2015 is that through a mixture of factors, both in March and then in particular in April, be it the difficulties with managing Greek debt, trends in terms of commodity markets, spilling over into other asset classes. It's like there was an overdose on QE in the European markets, and this led to a very pronounced peak in volatility in European fixed income, where volatility tripled by 3, and we see that also in the volumes here on this slide. If we move on to liquidity overview, I'm going to start with a spotlight of liquidity, and then go to a more systematic approach in terms of presenting a liquidity to you. We have 3 screenshots starting with Bund, Bubble, and Schatz options, and we see that liquidity is deepest for Bund options at the top, where if you need to trade on the touch anywhere between 250 and 1,500 contracts, that is possible. Bid-offer spreads are tightest for out-of-the-money expiries, and then anything with a delta greater than 50 typically doesn't see much investor interest as it is, as we can tell in the green bars with the contract volumes for calls and puts that are depicted here. Bubble options are usually quoted in 200 to 500 contracts. I think what's noteworthy is that we see that there's a tighter range of strikes that are in investor focus across these 3 products, surely also due to the lower price volatility levels of Bubble and Schatz options. And this is also given through the yield levels at which the underlying bonds of the futures that our options expire into are actually trading at. We've had negative yields on 2-year government bond paper basically for the last 2 years. Schatz bonds have been, yielding about -0.25 point, so -25 basis points. 5-year maturities have been more in the range of 0%. You give the government your money for 5 years and you get 0 for that. And that, has created both range-bound trading, but also led to a situation where in Schatz, for example, the type of strategies that are being traded there are just completely different than, what we're more accustomed to seeing in a higher volatility, more strongly moving product such as Bund options. We've had many Schatz expiries where through the duration of their lifetime, they only traded, maybe through 1 strike over a course of, 2 to 3 months. As said, that was much different in Q2. Liquidity is better in the front months than it is for the back months. I don't want to focus on this too long, but we see, just looking at Bund futures, that on a top level, it looks to be okay. What's quoted in March 2016 futures, 3 ticks wide for 30 contracts. But if we look deeper into the market depth of those futures, we then see why the respective options that expire into March 2016 futures are quoted much thinner, typically in sizes between 50 and 250 contracts. We also see in green, again, the contract volume for the calls and puts, that investor focus is not quite yet there. This will change over the course of the next weeks. When March futures become liquid, market makers will up their markets in terms of the quoted sizes and the tightness of their spreads. We also have some figures here in terms of average order book metrics. It I always think it's unfair just to show a screenshot because, I can time that. I can, do it at 14:30 at a time of day when it's particularly liquid. So I picked May and September 2015 when we had both very, very different volatility levels in Bund options, 9% in May and 5% in September. And what we have here is the average bid-offer spread of calls and puts, the average bid and ask volumes that were available on the inside market for a broad range of strikes that were in focus of trading throughout that time, just to underline that, yes, consistently, if you need to trade 1,000 contracts in and out of the money, you can do that directly against a quote. This doesn't mean that more liquidity is not available. I, always stress in options trading that there's a lot of mid-market action that goes on when investors come to the market, quotes being replenished, or where, market makers decide with a tighter range of fair value corridors to also respond to incoming order flow. Well, why just settle for calls and puts when members of the exchange and their clients can also request tailored option strategies either via the GUI or through ISV systems that they're using. Here, just a sporadic screenshot to highlight that ratio bulls, ratio bears, put butterflies, bull spreads, the flavor you choose, the strikes you choose, and the expiry you choose. Order books are created for this. Market makers respond to these strategy requests, as they're called. We see that size-wise, again, in the vicinity anywhere between 100 and 1,000 contracts can be available on the touch. Of course, the risk profile of these strategies also speaks for different quality of bid-offer spreads and implicit transaction costs that arise from that. And we have quite a good deal of investor take-up with depicted on the right side in the graph, daily volumes going in excess of 30,000 contracts a day. So basically, 1/3 of all of our screen volume is now transacted as an option strategy. So I've touched on some of the less mainstream investment styles, and this is our big wheel of liquidity, who interacts in our markets. In no particular order, yes, there is a great amount of global macro hedge fund trading in Bund Schatz options, and then there are also the traditional asset managers and PMs from insurers who get things rolling, who are serviced by sell-side derivatives bank dealing desks, execution brokers, or interdealer brokers, who ensure best execution. As well as specialized, options market makers who may operate within a bank. I think what's noteworthy in Bund Schatz options is the role of liquidity providers, of professional market makers, who may be owner-operated prop shops, but who, some of them coming from the old life floor have continued to be able to establish a presence in this market and make sure that liquidity needs finds its matches both electronically and in phone market trading. Having a look at some of the strategies at hand, I mean, the most obvious reason to use a government to use an option, to use a bond option, is to protect, an existing bond portfolio against price risks. And what I have here is the Bund futures chart just over the last year, which kind of shows how we've seen this unprecedented increase in prices from 150 to 161 that in yield terms, pounded us down to levels of about 25 basis points for 10-year paper, and how that all came to an end at the end of, as we, went into April of this year, and then, slowly in price terms, inching back upwards, as also last week, with no greater drama, Draghi is again on the line saying that, the program may be extended, the quantitative easing program may be extended, continuing to keep markets busy and keep traders busy with opportunities out there. Maybe to a lesser extent, but we also have a number of clients who use bond options to hedge risks coming out of government bond issuances, but the broader field is surely how people use bond options to enhance returns. So how can I generate some alpha out of this? I think there's 2 points to highlight. I can do this in a premium efficient manner, be it via call spreads. I may decide to write those. I may decide to buy those to position myself to express a certain market view. And then there's also an increasing deal of inter-product trading that goes on between Bund options and options on 10-year Treasury futures, where some investors are exploring spreads both in the government bond yield curves themselves, but also using inter-product spread trading, to position themselves also in volatility terms. If I look at this graph, I see that, traditionally, or coming from 2014, U.S. vol traded at a premium to European vol, in particular for 10-year government bond futures, and looking at the implied volatility of the options on those futures. But that all reversed this year when the QE overdose in Europe set in. Then all of a sudden it was exactly the other way around by quite a margin, where Bund vol was considerably higher, and this price volatility was not completely transported across the Atlantic to the U.S. Treasury markets. Coming to utilizations for implied volatility, nothing new to options traders, but just for completeness sake, there's one of the most riskiest ways of generating additional returns is systematically selling short volatility. So I'm tempted by the fact that in a range-bound market, I could think that the volatility, as I've depicted here in green in September, was kind of high. It was 6.5%. Looking at averages over time, do I believe it's going to stay high? Maybe not. If so, I go short vol. Maybe I decided to do that systematically since May of this year. That all works nicely, dependent on the price limits that I have in place. From from a portfolio management perspective, my blow-up risk is something that I have to manage in that context. But nonetheless, one full vol point and a drop over a 1-month period is significant. But we also speak to a lot of the portfolio managers, in particular here on the European side of things, who use volatility sensitive strategies to pinpoint certain price developments that they may see in the bond markets, be it in deposit rates, where they will then try to pinpoint where the Schatz is going to be in 6 weeks' time or in 3 months' time. Or then even the more sophisticated users out there who look to do and identify opportunities to have volatility arbitrage between swaptions markets and our listed transparent fixed income markets. So last but not least, bridging the gap over the Atlantic, and here focusing on some of the nuances and differences. I mean, when looking for peers in options trading on bond futures, you surely can't go by the CME with their 500,000 contracts a day Treasury options complex. And in all fairness, the U.S. cash and derivatives markets has always been larger, so there's more debt outstanding in the U.S., but it's also been more homogeneous because it's, only one sovereign issuer, the Treasury. And what's also been noteworthy, I think in particular over the, last 5 years, so to say, is that U.S. markets for cash bonds have really evolved to electronic trading, whereas most secondary markets for government bonds still trade OTC in Europe. And, this is something that we factor in, but with actually market makers factor in, and which we can see in the poorer liquidity, for example, of back-month futures, as there's just more uncertainty in the market in terms of implied repo rates and where these are trading, and the difficulties arise from the opaqueness of OTC trading of bonds themselves in terms of where that March futures should be. And then there's screens, pits, and phone markets and how they all stand against each other and where investors can get the best possible prices. The CME has had quite some success over the last few years, bringing a good deal of the pit trading to electronic trading. And I think they've also done this, by virtue of a market model that they have in place in which, order flow is not only allocated by, only by virtue of someone's price and timestamp, but also by virtue of a market-making performance score, where then the highest performing market makers then automatically participate in this incoming order flow. This is a market model we've tested in Europe. We haven't yet found any takers for that. have to comment that it also raises the bar for new entrants, because if I'm new to the game, I don't get to participate in this, benign order flow in a secured fashion, because I may not be yet, high up in the scoring as, some of the more established market makers are. Last but not least, a little my flag in the wind, or in terms of what phone markets can do for you, purely comparing them with the pit, people don't see each other. Quotes are made independently from one another, from separate locations, and this has led to a market model in which many of our product users consider this to be a quality, but where we as an exchange have never stopped trying to develop additional business on top of that, and in terms of establishing new liquidity pools with a special focus on electronic quotation. And that concludes my part of the webinar. Thank you very, very much to Iqbal for managing through the slides with me in this difficult setup for me. If you do have any questions, of course, Matthew Sharp is your man on the ground in Chicago, who represents our fixed income products for Eurex's sales team there, or feel free to contact myself either with questions through the WebEx or at a later point in time. And with that said, I'm happy to hand things back over to Loren Reinhardt, who has, I think, some interesting system demonstrations waiting for us.
Danke schön, Rex. Iqbal is going to address a quick question from a customer.
Yeah, Rex, we had a quick question on why block size was so low.
We actually increased it last year by a factor of 6 for Schatz options. So it was 50 contracts across the board, and after many fights with interdealer brokers who had the fear that this would infringe on the efficiency of trading there, they're somewhat lower than the 1,500 I think that are in place for treasury options. Yes, but
okay.
It hasn't really impeded market makers' ability to provide size on screen yet, or I don't know. Not yet, not at all.
Okay, I'd encourage folks to keep asking questions, and with that, we'll turn it over to Loren to walk through the Metro demo.
Great. Thanks again, Rex. Appreciate your insight into Eurex marketplace, and as it relates to kind of the various things that you talked about. I'm just going to go through quickly a couple of quick examples in our software to actualize the different ways to interact with order flow on Eurex Exchange. So the first thing that I'll highlight, and what Rex mentioned in his presentation, is kind of building spreads and being able to access kind of spread book functionality, in addition to requesting markets or liquidity or quotes on the spreads that I might be interested in. So by quickly clicking on strikes in our system, I can populate kind of the exchange recognized spreads, so you can see kind of a list of the different spreads here with my actual theoretical value. Then by selecting that, so I'm looking at this call vertical here, I can open up kind of a trade ticket that shows us the deeper Greeks, the market bid-ask information, our theoretical price, and then I can actually RFQ that, so that I'm asking market makers and market participants to show me what their bid or offer and size is on a particular instrument that I would develop or create in the RFQ functionality. I can then view that RFQ book in our Exchange Request Viewer widget. So now what I can do is I can actually come in here and I can click trade these. I can generate a kind of semi-automated response by putting in my bid and ask guides, the quantity that I want to respond with, and the time that I want that quote to be out in the market. And the kind of third piece of the puzzle here is actually auto-responding to these markets. So I can create missions, which uses our kind of target finder functionality to actually auto-respond with various metrics that I put in, whether it be timed expiration, delta ranges, vega ranges, specific products, I can then create a mission so that if there's an order out there that meets my criteria, then I'll auto-respond with a certain amount of edge into the market, which is very nice functionality. It kind of easily improves the workflow of a trader so that he's not constantly having to manually sift through all of the requests that are out in the marketplace and trying to, kind of manage his edge based on each individual order that comes into the market. You can see here, this is just our basic, our futures book depth ladder, so I can enter futures orders here by just clicking in these boxes and scrolling my mouse wheel to kind of show the quantities. And then the final thing that I wanted to highlight really quickly is our ability to quote these products, which is very simple. So, of course, we have on the back end all of the safety settings that won't be required to make them confident in disseminating quotes to the marketplace and providing liquidity to a market. Protections like fast underlying movements, trade quantity backout. So if I do get hit on a large number of contracts, then I can kind of back out my quotes. You can see here in the gray columns, these are the quotes that I'd actually disseminate into the market on the bid and the offer. And it looks like the market's now closed, so we don't have market data in here, but you can still see I am generating theoretical prices. And turning on quotes in our system is as simple as kind of highlighting the strike range. I have all of the different strikes selected here, which I'm sure my colleagues here at the Eurex would appreciate. Someone quoting every strike and a product here. But it's as simple as kind of typing in edge that I would like to be. So if I want to be kind of a nickel round in the bid and the offer, and simply apply that, and you'll see it'll update my quotes in the gray columns here, so my offers here on the puts, my bids on the puts, my offers and the calls, and my bids and the calls. And then I can set the quantity that I want to have up on each side, and I can apply those. And then it's as easy as just starting my quotes in the market. So everything that I have selected will turn on if the market was open, and you would see these cells highlighted green to then be able to electronically quote those markets. One thing I will mention is for some of the over-the-phone side of the business, or the OTC side of Eurex, the trade sheets and pricing functionality also equally applies there. So being able to quickly respond to phone broker markets by pricing things up and understanding what my theoretical value is, kind of makes me quick and efficient to respond to those markets. But those are kind of the highlights of our Metro Now product as it relates to some of the elements that Rex spoke about in the slides. And at this time, I'll turn it back over to Iqbal to kind of wrap things up here. But we appreciate everyone's time and joining us for the webinar, and certainly appreciate the partnership that we have with Eurex.
Yeah, we'll just hold on a few seconds here to see if there's any questions that have come through. I don't see any. So with that, I want to thank everyone for joining today, and we appreciate the time. Thanks very much.